Hello everyone, welcome to Cam Calderon PhD. If you are passionate about understanding the intricacies of economics versus the financial world, you are in the right place. Our channel is dedicated to demystifying the complex universe of stocks, bonds, and economics. Subscribe, join my community, and step into the circle of knowledge that I designed to support you. Thank you for watching. Do not forget to subscribe, click on like, and send me your comments. Okay, I have titled this video or film recording The Labor Market, a tale of a slow motion landing. No hard, no soft, and no landing. So I believe that the conclusion is in the title. Yes, I believe that the US economy is actually landing in a slow motion. So last week, the US non-farm payrolls presented a lower than expected figure of 175K, surprising the market. April's data showing 175K dropped from March 303K and fell short of the market consensus, which was 243K, which was based on a survey of 72 market participants. The StarMine Smart Economics model had predicted a slightly higher figure of 240K, anticipating an economic surprise of minus 2.4K. Note the decreasing pattern here on these figures and the reading, which was the lowest since October 2023. So this means that although the figure is low, to be honest, the situation is a little bit better still than the pre-pandemic levels, yes, and is still a bit volatile or fluctuating, if you want, yes. So yes, it was low, it was a surprise, but not a major surprise. I think it's a slow motion. Here we have that March non-farm payroll increases were upwardly revised to 350,000, while February's figures were adjusted downwards to 236,000. The average employment gain over the past 3 months now stands at 242,000, down from 269,000 in March. This suggests that while job growth is slowing, it remains very robust. In April, payroll gains were more evenly spread than in previous months. The bulk of the increase came from the private sector, which added 167,000 jobs. And note this, the employment in goods producing sectors grew only 14,000, and the service sector employment saw a more substantial rise of 153K, indicating ongoing strong demand in services. So unfortunately, service is not cooling down as we need in order to interest rates to decrease, a stock exchange to go like a rocket, or certain shares that are interest rate dependent, or the bond market as well, which benefits from decreasing interest rates. I mean, the price goes up when the interest rates goes down. The leisure and hospitality sector experienced a smaller increase of only 5,000 jobs. In addition, there was a modest rise in employment within the construction and government sectors in April. Government employment increased by a lower than expected 8,000, making the smallest monthly rise since September 2022. Let's let's carry on our analysis with the US job openings total data, which represents non-farm job openings across the US economy. For March, the figure reported was 8.4 million, notably lower than the market's expectation of 8.686 million. According to Reuters polls, this figure even fell below the lowest forecast of 8.5 million. So all forecasters actually, even the lower forecaster didn't got the numbers right. So the report adds to the growing mosaic of indicators signaling that labor demand is cooling, but cooling slowly. It's particularly interesting to observe the downward trajectory in the data, dropping from the high of 12,182 million in March, or 12,182,000 in March 2022 to the latest figure, a drop of 30%. This decline follows a significant upward trend from a post-global financial crisis low of 2,232,000 in July 2009, a rise that was briefly disrupted by the COVID crisis in 2022. So it's worthwhile to keep an eye on the upcoming JOLTS job opening releases, especially concerning the level of 7,594. The previous high which was the previous high in 2018, which will mark a 37% decrease from March 2022. Currently, both manufacturing and non-manufacturing sectors are showing data values under 50, which indicates contraction in employment conditions and could suggest a looming overall contraction in the US economy. However, a closer look reveals a more nuanced picture. The non-manufacturing employment survey has decreased to 45.9, down from 48.5, while manufacturing employment survey has increased to 48.60, up from 47.4. Historical analysis reveals that past US recessions were typically marked by significant contraction in manufacturing employment. You can see this in this graph on this slide, a trend not mirrored by April figures. In fact, my perspective will only shift if the manufacturing employment survey were to drop below 45.9, a threshold historically associated with the onset of a recession. So if in the graph, if we don't decrease below this zone of 40.90, I would not say that we are possibly in a danger of recession. According to the Federal Reserve Bank of New York, the minimum salary job seekers are willing to accept for a new role has reached its highest point since records began in 2014. So the regional Fed Bank survey shows that on average individuals now expect $81,000, a little bit more, almost $82,000 to consider switching jobs. So you can see that actually the other side, the supply side of the labor market is a bit tight as well. People is asking more money. This figure has risen by about $10,000 since March 2021, when inflationary pressures were beginning to intensify. This increase is more noticeable among men, younger employees, and those in higher income brackets. As of March, rising living costs, the so-called reservation wage, the lowest wage at which a worker would accept a job for men, stood at $95,500, which is 29,000 more than that of women. Comparatively, 4 years ago, during the onset of the pandemic, the wage gap between men and women was only $21,700, $21,700. So you can see that actually all segments of the labor are actually asking for more money to switch sides, if you want. Right. On this slide, I think I wanted to show you possibly one of the charts that is showing some opposite or diverges from my conclusion that the market is slowing like slightly, like over time. Yes, so here we have the Indeed job openings, and but note this, even if the graph is indeed showing that since 2022 job openings are decreasing. We are now like 14% or 13% from like in distance from the pre-pandemic levels in 2020. But still, I think I will say that if the market will go to the levels of 2020, I think if we use the trajectory on this graph, possibly a recession will start in 2025, or the pressure of having an economy with similar job openings and of 2020 pre-pandemic is still far away, right? Still, this slide from the point of view of labor is showing that the economy is slowing down at a high rate, but there is still time to arrive to a level in which we should be very worried. As of April 2024, there were 1.3 million people who had been unemployed for 20 weeks or longer, accounting for 19.6% of unemployed individuals. In comparison, long-term unemployment represented 19.4% of the total unemployed in April 2023, 23% in April 22, and reached a recent high of 42% in March 2021. So I think that that on pre-pandemic levels, that we are on pre-pandemic levels, and there are actually not like meaningful headwinds in the duration of employment so far. So another a chart that is showing us that is kind of stability. So you can see that we have here a plateau here in this area of the chart. So there is nothing about the duration that is indicating that we should be worried at the moment. Okay, I would like to say at this point, thank you for joining us for this detailed review that I am preparing today. I am starting my YouTube channel, so please subscribe. And as a wrap up for today's presentation, let us summarize some key takeaways and look ahead at what's coming in economics. So first of all, as a takeaway, number one, job growth. The US economy added 175,000 jobs in April, the slowest gain in 6 months and falling below market expectations. The unemployment rate, a slight increase in this unemployment rate, moving from 3.8% to 3.9%. Average hourly earnings, growth in average hourly earnings, right? This growth decreased and falling below 4% year over year for the first time since June 2021. So yes, it's decreasing slightly. The labor market outlook. Yes, there is a weaker job data for April. Initial claims for unemployment insurance do not indicate a significant weakening anyway. In terms of the Federal Reserve outlook, the April jobs report should make the Fed wait for more robust confirmation that inflation will be on the 2% target. That is my analysis, although many analysts in the market are telling that, oh, these reports are telling that the Fed should carry on with their commitment to decrease the interest rates. I do not believe so. I think the evidence that we have covered here is that even though when there is some cooling, I don't think is strong enough to get the 2% target. So personally, I believe that the market is getting tighter on both demand and supply of labor, and the data suggests to me a slow motion landing scenario to 2%, rather than hard landing, soft landing, or no landing. However, a key forward-looking indicator is, of course, the Indeed job openings, because it's more forward-looking. That suggests that we will be at pre-pandemic levels perhaps in 2025, early 2025. Also, sentiment surveys, including the Institute for Supply Management and the NFIB, have been flagging a sharp slowdown in the labor market. My analysis in terms of hard landing, well, my slow motion landing analysis, obviously does not take into account any problems such as liquidity crisis or credit accidents, which may happen or not before 2025. So these are the conditions of these regimes in which interest rates are very high. You will never know if there is going to be an accident in any sector or in any place of the economy. Politically, I see changes in regimes from the political right to the left and vice versa. This is due to social upsetting about the labor conditions, which are tight. I think this is happening, possibly I will dare to say, in the United States and in the UK where I live. By the time I am recording this video, weekly jobless claims increased 22,000 to 231,000, and continuing claims rise 17,000 to 1.7 million. I agree the labor market shows some signs of rebalancing, with fewer job openings posted around the country, and now company lays off are picking up, hinting at caution on the part of companies as they weigh the outlook for the second half of the year. The meaning for the stocks and bonds. I believe that the interest rates have peaked and yields have peaked. I'm starting hoarding bonds. I carry on buying bonds now. Treasuries, that is my decision. My personal goals also support that view. Whether the Fed is going to decrease the interest rates, the possibilities of a decrease are there, yes, because politically the Fed might feel the pressure to do so. In terms of numbers, at least in terms of labor, in terms of inflation, I think the conditions are not there, simply not there. So if they do decrease the interest rates now, I think it will be more politically motivated, the pressure of the public possibly, but the conditions are not there. So I will wait a little bit. I will be still cautious in my investments in the stock market. And possibly I will look very well, very carefully where I put the money at this very moment. As I said before, even though when these numbers are not bad, that might be bullish for the stock exchange. These conditions are still tight. You will never know what happened if there is an accident. So that is my take. Thank you very much for seeing this video, for joining us for today's insightful discussion on the labor market, the US labor market. If you have questions about today's content, want to get more information into specific data or need education linked to your investments, do not hesitate to reach out. So you can contact me via email to cam.calderon@gmail.com or connect with me or us on this YouTube channel. So please subscribe. All these links are available in the video description below, so please check them out. Remember, investing is a journey, and we are here to discuss everything with you, all steps in the way. For more insights and updates, make sure to subscribe to my YouTube channel. This way you won't miss out of any of our upcoming videos. Thank you once again for watching, and I look forward to seeing you in our next video. Please note that the information provided in this video is for educational and informational purposes only. It is not intended as financial advice. Always consult with a professional financial advisor before making any investment decisions. Bye-bye.